Hello everyone, John AG here. Welcome back to my channel Aurex. If you haven't yet subscribed to my channel, in this channel you will find the real information, real market updates that everyone cannot tell you. So please subscribe this channel and love you all of my subscribers for your support. And please watch this video till the very end because YouTube will not push my videos to more people. Today is June 2nd, 2026. I need you to anchor yourself to this date, to look around at the world you are standing in right now, and to listen to me very carefully. The financial mainstream media, the pundits in their tailored suits, the anchors reading teleprompters on the major networks, want you to believe that the storm has passed. They are pointing to the recent pullback in the precious metals market, noting that gold has retreated to the $4,400 range after its historic, face-melting run to nearly $5,600 earlier this year. They are pointing to silver, taking a breather after finally shattering the multi-decade $54 ceiling, and they are whispering a very dangerous word. They are whispering collapse. They are telling you the rally is over, that the safe haven trade has run its course, and that it is time to cycle your hard-earned money back into the speculative casino of paper assets. Do not fall for the illusion. They are lying to you, or worse, they simply lack the capacity to understand the macroeconomic avalanche that has already been triggered and is currently gaining terrifying momentum just out of sight. We are going to look past the smoke and mirrors today. We are going to dive deep into the real data, the raw human impact of the global debt spiral, the geopolitical tinderbox burning in the Middle East, and the mathematical impossibilities facing the architects of the global financial system. The countdown to the ultimate re-rating of gold and silver has not been canceled. The countdown is back on. The silent theft of your life's energy. Before we look at the charts, before we talk about technical breakouts, moving averages, and institutional order flows, we have to talk about something far more important. We have to talk about you. We have to talk about the human element of what is happening to the global economy right now. Because economics is not just a study of sterile numbers on a spreadsheet, it is the study of human action, human suffering, and human survival. Over the last few years, you have felt a quiet, insidious theft occurring in your daily life. It is a persistent shadow that follows you everywhere. You feel it when you stand at the checkout counter and stare at a grocery bill that makes your stomach drop. You feel it when you pay your utility bills, watching the cost of keeping the lights on eat away at your disposable income. You feel it most profoundly when you look at your savings account and realize that despite working harder, longer, and smarter than ever before, the finish line of financial security keeps moving further and further away. You are running on a treadmill that is accelerating, and you are being told by the people at the controls that everything is fine. This is the hidden tax of fiat currency degradation. It is a tax that is never voted on, never debated in the halls of Congress, and never explicitly explained to the public. For decades, the entire global financial system has relied on a foundational collective myth that a piece of paper or a digital digit flashing on a bank's computer screen holds intrinsic value simply because a government declares it so. But let me make this abundantly clear. Value cannot be printed. Wealth cannot be conjured into existence by a central bank chairman pressing a button in a boardroom. When governments dramatically expand the currency supply to fund endless deficits, to bail out failing institutions, and to finance global conflicts, they are not creating new wealth. They are actively diluting the purchasing power of every single unit of currency you currently hold. They are transferring the purchasing power from your savings account directly to the state. To truly grasp the sheer mathematical brutality of this phenomenon, we must look at the classical macroeconomic equation of exchange, which defines the inescapable relationship between money supply, velocity, price levels, and economic output. M times V equals P times Q. In this immutable law of economics, M represents the money supply, V is the velocity of money, P is the general price level of goods and services, and Q is the real economic output. When central banks wildly inflate M to monetize insurmountable national debts, while Q stagnates under the crushing weight of structural inefficiencies, overregulation, and fractured global supply chains, the only possible mathematical outcome is a violent upward explosion in P. That is the price you pay just to survive. Your savings are melting like ice cubes in the summer sun. The purchasing power of the middle and working classes is being systematically strip-mined to service the obligations of the sovereign state. This is not a mistake. This is not an accident of monetary policy. This is the policy itself. And it is this exact, deliberate policy of currency debasement that is currently driving the smartest, quietest money in the world, sovereign wealth funds, Eastern central banks, and ultra-high net worth family offices, out of paper illusions and into physical, undeniable reality. They are retreating into the ancient fortresses of gold and silver. The anatomy of a manufactured pullback. Let us address the elephant in the room regarding the current price action. In January of this year, 2026, we all watched as gold surged to an astonishing all-time high of $5,595 per ounce. It was a breathtaking parabolic move, driven by tariff uncertainties, overwhelming demand from physical ETFs, and an aggressive, panicked rotation out of risk assets. It felt unstoppable. But I need you to remember a fundamental rule of markets. Nothing moves in a straight line. Not in nature, not in physics, and certainly not in highly leveraged financial markets. Over the past few months, we have witnessed gold correct by roughly 15% to 20%, bringing us back to this $4,400 to $4,500 consolidation zone as of today, June 1st. The paper market speculators immediately panicked. The high-frequency trading algorithms triggered their cascading stop losses. The institutional short sellers seized the narrative, utilizing the rhetoric of higher for longer interest rates from central banks to aggressively hammer the paper price down. They created a spectacle of defeat. But here's the hook you must not miss. You absolutely must understand the fundamental difference between the paper market and the physical market. The COMEX futures market, where these prices are dictated on your television screens, is a grand theater of leverage. It is a derivative pricing mechanism where hundreds of unbacked paper claims can exist for a single physical ounce of metal sitting in a vault. When liquidity tightens in the broader financial system, the paper market experiences violent, forced liquidations. Traders sell their paper gold contracts not because they want to, but because they have to meet margin calls somewhere else. However, the fundamental drivers, the deep, tectonic, structural reasons why gold initiated this historic bull run in the first place have not disappeared. In fact, if you look closely at the macroeconomic data, those drivers have radically accelerated during this exact pullback. Mainstream analysts will confidently tell you that because central banks are keeping nominal interest rates elevated to fight sticky, persistent inflation, gold, which yields no interest, must inherently fall. This is a profound misunderstanding of how global capital actually flows. Gold does not compete with nominal interest rates, it competes with real interest rates. To calculate the true, authentic yield an investor receives on their capital, we must use the precise real interest rate formula. R real equals 1 plus I, 1 plus pi minus 1, where I is the nominal interest rate offered by the bond, and pi is the actual, on-the-ground rate of inflation. When true inflation runs hotter than the yield on government bonds, the real interest rate becomes deeply, structurally negative. Even if a treasury bond pays you 5%, if your real, lived cost of living is rising by 8% or 10% a year, your purchasing power is bleeding out. You are locking your money up to be guaranteed a mathematical loss of wealth. In a world defined by negative real yields, gold is not just a defensive safe haven. It is the only mathematically sound preserver of purchasing power available to humanity. The sovereign debt trap and the death of options. Ask yourself why the central banks cannot simply raise rates to 10% or 15%, the way Paul Volcker did in the early 1980s, to finally crush the inflation disease once and for all. The answer is terrifying. The mathematical foundation of the global economy has fundamentally mutated since 1980. Back in the 1980s, the US federal debt to GDP ratio was hovering around a manageable 30%. Today, standing here in 2026, the US federal debt exceeds 120% of GDP, and the annual fiscal deficits are running near a catastrophic 6% to 7% of GDP during an economic expansion. This is unprecedented outside of world wars. Let me paint a very clear, very stark picture for you. When a sovereign nation becomes this heavily, astronomically indebted, the mere cost of servicing the interest on that debt becomes the primary driver of national bankruptcy. At current interest rates, the annualized interest payments on the US national debt alone are completely eclipsing the entire defense budget. They are eclipsing Medicare. They are consuming the tax revenues of the nation before a single road is paved or a single pension is paid. We have crossed the event horizon of sovereign debt. The mathematics of compound interest are no longer working to facilitate the prosperity of the nation. They are working to entirely consume it. If the Federal Reserve or any major Western central bank raises interest rates high enough to actually cure the inflation disease, they will instantly bankrupt their own governments. The Treasury will be forced to default on its obligations, and the global bond market, which serves as the foundational collateral backing the entire architecture of the global financial system, will collapse in a matter of days. The banking system would freeze overnight. If, conversely, they panic, pivot, dramatically lower rates, and return to massive quantitative easing, money printing, to artificially monetize the debt and save the bond market from implosion, they will completely destroy the currency. They are trapped in a box of their own design. There is no secret third option hidden behind the curtain. They must choose between a sovereign debt crisis that collapses the banking system or a currency crisis that destroys the purchasing power of the money. History tells us, with an unbroken 100% success rate spanning thousands of years from Rome to Weimar to modern day, that governments will always, without exception, choose to sacrifice the currency to save the state. They will print. They have to print. And when they turn those machines back on, the explosive, violent re-rating of physical gold and silver will make the January 2026 highs look like a rounding error on a historical chart. The geopolitical realignment and the Great Eastern Hoard. While retail investors in the West are being shaken out of their positions by the recent engineered price dip, handing their physical metal back to the bullion banks at a discount, you need to ask yourself, who is buying? Who is standing on the other side of that trade, absorbing every ounce of physical metal that comes onto the market? The answer should send absolute shivers down the spine of every Western fiat apologist. It is the East. Central banks, particularly those within the expanding BRICS nations, are accumulating physical gold at a staggering pace not seen since the formation of the Bretton Woods system. Throughout 2024 and 2025, central banks bought well over 1,000 tons of gold annually, draining Western vaults dry. Even as we move through the middle of 2026, conservative projections estimate these same central banks will acquire another 750 to 800 tons this year. They are not buying paper contracts. They are demanding delivery of good delivery bars, loading them onto cargo planes, and repatriating them to sovereign vaults in Beijing, Moscow, New Delhi, and Riyadh. Why are they doing this with such urgency? Because the aggressive weaponization of the US dollar system in recent years taught the rest of the developing world a brutal, unforgettable lesson. If you hold your national wealth in another country's fiat currency or inside another country's banking system, you do not truly own your wealth. You are merely renting it, subject entirely to their political whims, sanctions, and confiscation. We are currently witnessing a massive, coordinated de-dollarization trend unfolding in real time. Entire nations are establishing alternative payment systems, settling vital bilateral trade in local currencies, and backing their sovereign reserves with physical, unconfiscatable gold. They are building a parallel financial system, brick by brick, ounce by ounce. Furthermore, look at the geopolitical landscape surrounding us right now, today, in June 2026. The Middle East remains a terrifying tinderbox. Tensions are escalating rapidly, constantly threatening the vital shipping lanes of the Strait of Hormuz and the stability of global energy supplies. Supply chains are aggressively fracturing as the world bifurcates into distinct, competitive, and increasingly hostile geopolitical blocs. In times of intense existential geopolitical stress, gold fundamentally transitions from a mere investment asset into a sovereign survival mechanism. It is the only financial asset on the balance sheet of the world that carries absolutely zero counterparty risk. When you hold physical gold in your hand, you do not require a counterparty, a bank, or a government to make good on a promise. It is not a claim on wealth, it simply is wealth. The awakening of the indispensable metal. Now, let us turn our focused attention to the sleeping giant of the commodities complex. Let us talk about silver. If gold is the silent, immovable bedrock of the global monetary system, silver is the indispensable, hyperactive nervous system of the modern technological world. For 13 agonizing years, silver investors suffered. The price was trapped under a massive, impenetrable technical ceiling in the $50 to $54 range. It was manipulated, suppressed, mocked by mainstream analysts, and largely ignored by the broader investment public. But in late 2025, that historical ceiling finally shattered, and silver surged an astonishing 120%, firmly breaking free and entering true price discovery territory. Yes, it has experienced immense, gut-wrenching volatility since then, pulling back sharply in the first quarter of 2026 to shake out the leveraged weak hands. But the structural, fundamental foundation of the silver market has mutated forever. Unlike gold, which is primarily hoarded in dark vaults and treated as money, silver is violently consumed. It is destroyed. It is the most electrically conductive, thermally conductive, and highly reflective metal on the entire periodic table of elements. For the technologies that are driving the 21st century, there is no known substitute. Consider the immense, compounding drivers of this consumption. First, the green energy transition. Solar photovoltaic panels require massive amounts of specialized silver paste. As governments worldwide mandate and heavily subsidize the relentless push toward renewable energy, The demand from the solar sector alone is eating into global above-ground stocks at a terrifying rate. We are talking about hundreds of millions of ounces disappearing into solar fields every single year, never to be recovered. Second, the electric vehicle revolution. An EV uses nearly double the amount of silver as a traditional internal combustion engine vehicle. Every single electrical connection, every autonomous sensor, every complex computer board requires silver to function with absolute reliability. As the global fleet transitions, the draw on silver becomes a mathematical black hole. Third, and perhaps the most explosive catalyst of all, the artificial intelligence revolution. This is the massive demand shock that absolutely no one in the forecasting models saw coming just 5 years ago. AI data centers are massive, heat-generating behemoths that require vast, unprecedented amounts of electricity and highly efficient, densely packed semiconductors. The physical infrastructure required to cool, power, and connect these massive AI hubs is incredibly silver-intensive. The computing power required to run the future of humanity runs on a highway of silver. We are now officially entering our 5th consecutive year of a massive structural supply deficit in the global silver market. The world is consuming far more silver than it is pulling out of the ground. The mining sector has been starved of exploration and development capital for over a decade. You cannot simply flip a switch and command the earth to yield more silver. It takes 10 to 15 years of permitting, capital allocation, and heavy engineering to bring a new Tier 1 mine from discovery to commercial production. The demand curve is steepening exponentially. The supply curve is flatlining. The paper-to-physical ratio on the COMEX is a ticking time bomb waiting for a spark. The moment the major industrial users, the massive solar manufacturers, the trillion-dollar tech giants, the legacy automotive companies, realize that there is simply not enough physical silver in the registered vaults to meet their immediate production needs, they will bypass the paper futures market entirely. They will begin panic hoarding physical metal. When an industrial giant cannot source a few ounces of silver, their multi-billion-dollar assembly lines grind to a complete catastrophic halt. They do not care if silver is priced at $50, $100, or $200 an ounce. The cost of the silver is a fraction of the final product. They will gladly pay whatever premium is demanded to keep the lights on and the factories running. When that guaranteed industrial panic inevitably collides with a sudden monetary panic from retail and institutional investors fleeing a collapsing, devaluing fiat currency, silver will experience a physical short squeeze that will permanently alter the landscape of the financial world. It will make the historic squeezes of the past look like a warm-up act. Experts at major legacy financial institutions are conservatively projecting silver in the $56 to $65 range by the end of 2026, but the raw technical extensions, driven by physical deficit, suggest targets of 72, 88, and well beyond once the psychological dam truly breaks. The psychology of the shakeout and the mathematics of attrition. Why are so many average retail investors feeling discouraged right now? Why are they clicking away from the charts, selling their coins, and walking away just when the fundamentals are reaching their absolute peak? Because they are playing a psychological game designed by experts to break their will. The entire fiat financial system survives on one unquantifiable metric: confidence. It is a confidence game. The architects of this system use engineered price volatility as a psychological weapon to shake weak, fearful hands out of real, tangible assets. When gold dropped from $5,595 down to $4,400, it was not a failure of the asset. It was a maneuver engineered to create maximum despair. It was designed to make the average person throw up their hands in frustration, sell their physical metal back to the very bullion banks that shorted the paper price, and return to the false, comforting safety of a 4% yield in a digital money market account. But you have to train your mind to look at the larger time horizon. You have to understand the math of the game they are forcing you to play. Let us accurately calculate the destructive, silent power of inflation over time. The future purchasing power of your money is dictated by the compound degradation formula. FV equals PV times 1 minus pi to the power of t. If you hold $100,000 today, your PV, and the true real-world inflation rate, pi, runs at a highly conservative 6% for the next 10 years, t equals 10, the future purchasing power, FV, of your life savings will be absolutely decimated. You will have lost more than nearly half of your wealth while taking zero risk in the stock market. You are losing the war of attrition by simply participating in the currency. The smart money, the institutional giants, they know this formula by heart. While the average retail investor is panicking over a temporary 15% drop in the nominal paper price of gold, the central banks and sovereign wealth funds are quietly backing up the metaphorical truck and loading it with physical bullion. They are buying the blood in the streets. They are using the algorithm-driven price dips in the paper markets to accumulate real, physical tonnage at an incredible discount. They are transferring wealth from the impatient to the patient. The looming catalysts and the final call. So, what triggers the next massive leg up? What turns this current frustrating consolidation phase into a violent parabolic continuation that leaves the non-believers behind forever? We are tracking several immediate, highly explosive catalysts as we move through the second half of 2026. You need to watch these markers closely. First, the ticking time bomb of commercial real estate. Regional banks across the Western world are sitting on trillions of dollars of toxic underwater commercial property loans. Office buildings are sitting empty, valuations have plummeted, and the refinancing cliff is here. When these loans default en masse, the regional banking sector will face a solvency crisis that dwarfs the panics of 2023. The moment that systemic break occurs, and the math guarantees that it must break, the Federal Reserve will be forced into an emergency posture. They will be forced to slash rates to zero and inject trillions in emergency liquidity to prevent a deflationary depression. The very second they announce a return to easing, the dollar will plummet, and gold will reprice instantly to reflect the new, expanded money supply. Second, the COMEX delivery squeeze. As industrial demand for silver continues its relentless draining of registered inventories, we are fast approaching a critical, mathematical threshold where widespread delivery failures become a statistical certainty. A single major default on the COMEX, an event where a contract holder demands physical metal and the exchange cannot provide it, would permanently shatter the illusion of the paper pricing mechanism. It would instantly cause physical prices to detach entirely from the spot price on your screen. The premium for possessing physical metal in your hand would skyrocket overnight. Third, the geopolitical flashpoints. Any sudden kinetic escalation involving major global powers, any severe disruption of energy flows through vital maritime choke points, will send an immediate stagflationary shockwave through the entire global economy. Oil will spike, inflation will roar back to life with a vengeance, and the panic-driven safe haven demand for gold will become instantaneous, overwhelming, and utterly violent. Institutions like JP Morgan Global Research are already projecting gold to push aggressively back toward $5,000 by the fourth quarter of 2026, with long-term structural targets of $6,000 to $8,000 by the end of the decade. Goldman Sachs is quietly maintaining their targets above $5,400. I need you to understand that these are not fringe predictions from internet doomsayers hiding in basements. These are the calculated projections of the very institutions that manage the complex plumbing of the global financial system. They know the math. They know the debt is unpayable. They know the currency must inevitably be sacrificed to keep the sovereign state alive. My friends, we are living through a profound generational transition. We are watching history unfold in real time. The post-World War II monetary system, built on the premise of endless debt expansion, is finally reaching the absolute end of its mathematical lifespan. The era of unbacked, debt-based fiat currency is colliding head-on with the immovable, unforgiving reality of resource scarcity and physical limits. The powers that be want you constantly distracted. They want you arguing over trivial political theater, fighting your neighbors over scraps, and worrying about day-to-day noise on social media. They want you paralyzed by fear, unable to make the decisions that will protect your family's future. But true wealth is not built in the manic euphoria of a stock market bubble. True wealth, the kind of generational wealth that survives the collapse of empires, is secured when you have the sheer courage to understand the macroeconomic reality, look past the engineered volatility designed to scare you, and position yourself in the tangible assets that have survived every war, every plague, and every single currency collapse in the last 5,000 years of recorded human history. Gold is the ultimate, unrivaled insurance policy on a burning house. Silver is the vital, irreplaceable fuel of the technological future. This recent pullback in price is not a defeat. It is a profound gift. It is the universe giving you one last fleeting opportunity to board the life rafts before the ship of fiat currency fully and finally submerges. The countdown never actually stopped. It merely paused to let the smart, patient money accumulate the remaining supply. Now, the countdown is back on. It is ticking faster than ever. Prepare your mind. Protect your family's labor. Secure your purchasing power outside the digital, programmable control of the centralized banking system. Thank you for being here with me today in the trenches of truth. If you found this information valuable, if it opened your eyes to the reality of the board we are playing on, share it with someone you deeply care about. The mainstream media will not tell them the truth until it is far too late to act, so it is entirely up to us. Stay strong, stay incredibly vigilant, keep stacking, and I will see you in the next update.